So far, we focused mostly on technical analysis, trends, patterns, and trading indicators. But markets are not just charts. They are driven by real-world events, by news, and of course by economic factors. That's where fundamental analysis comes in. It helps you understand why markets move and not just where price might go on the chart. So in this video, I will give you a beginner-friendly overview of fundamentals, the main factors to watch, and of course how to combine them with your technical analysis. First, let's explain what is fundamental analysis. In simple words, is the study of economic, financial, and geopolitical factors that affect the value of the asset. Generally speaking, for currencies, it's mainly interest rates, inflation, employment data, and central bank decisions. For stocks, companies' earnings report, revenue, what the profit margins, and the overall news in the companies. And commodities, mainly affected by supply, demand, and geopolitical events. Think of it like weather forecasting. The charts show today's temperature, but fundamentals tell you whether a storm is coming or a sunny day ahead. As a beginner, you can focus on only few economic indicators, the ones that are highlighted. To find the economic calendars are the Forex Factory like the one I use here. Once you open the page, you can click on the calendar section, and from the filters button, you can filter out only the high impact news events. You can untick the medium and the low impact. You can leave the gray that shows when the major banks are closed, and the red, which is the high impact news. You can apply filter and you have this setup. One of the major economic indicator is the interest rates. The interest rates shows us how banks can influence borrowing cost and currency strength. Recently, in Australia, the Reserve Bank of Australia kept their interest rate unchanged from 3.6% previously. When a central bank increases interest rates, usually the currency strengthens, and when it decreases or keeps the interest rates unchanged, like they did recently in Australia and in the UK, usually the currency also devaluates. Another key indicator is the CPI, or Consumer Price Index. This is an inflationary leading indicator and simply shows that rising prices may lead to interest rates high. So it's connected directly to the decision of the central bank about the interest rates. Employment data refers to jobs numbers, shows economic health, like strong employment can strengthen the currency. And the GDP refers to gross domestic product. It reports monthly, like most of the high impact news events, and it measures the overall economic activity of a country. Let me give you a tip here. You don't need to memorize every indicator. Just focus on ones that moves your chosen markets the most. I will show you a few examples on how to combine the technical charts with the fundamentals to identify high quality trades. Look at this Euro-US dollar chart. The price is below the 50-period moving average, and the market has more bearish than bullish implications. At this time in the US, they were about to report the gross domestic product. See how the previews was 3.3%. The forecast was expecting the same report, but the actual beat the forecast by 0.5%. Let's go back to the charts. See right at the event when the news reported how the price dropped from this point to that point within 15 minutes. See how long is this red candle compared to the previous red and green candles. That means the market had a lot of market participants and a lot of volatility, pushing the price lower. The reason for that was because the euro is the first currency on the left and the US dollar is the second currency. When the US dollar gained strength, immediately pushed the euro down. So put them together. The euro versus the US dollar went down. And this is why a long red candle formed on the chart. So price below the 50-period moving average. The RSI was already below its middle line 50. Positive news events for the US dollar, and the price of euro versus the US dollar moved down. Let's see how this CPI, Consumer Price Index report reflected on the chart. The previous number was 2.7%, and that time the forecast showed an increase by 0.2%, and the actual confirmed the forecast. One of the biggest events in financial markets is the non-farm employment change event, and that's reported every first Friday, usually in the US. Here we see the previous number was at 79,000. The forecast estimated a drop to 75,000, but the actual number reported as only 22,000. At that time, the price on gold was above the 50 period. The RSI was already above its middle line 50, and that was calling for a buy signal. When the event reported and the US dollar immediately lost value because of the negative report, and at the same time, the price of gold went up. And why that happened with the gold? Because the gold is priced in US dollars. So when the price of the US dollar, the price of the gold immediately goes up. Even as a beginner, you can use fundamentals in simple ways. You can check major events before trading to avoid any surprises. You can also use economic releases to confirm technical trends. And the third is avoid entering trades right before high impact news if you are not experienced, or if you're gonna do that, so just use smaller position size. For your next trade, I want you to check whether a major news release is coming and adjust your plan accordingly. Either way, you can wait to trade after the news release, or you can reduce your position size. Here is a step-by-step trading strategy on how you can combine fundamentals with your overall trading. First, you have to identify a market that is trending. Second, you have to point your key levels of support and resistance on the chart. The third, you use the calendar like the Forex Factory, investing.com, or any other calendar you want to check for upcoming news or economic events that can directly affect your trading outcome. And once you do that, the fourth step is to decide whether you're going to take the trade, or you're going to wait after the news events to place the trade, or if you're going to trade, you might want to reduce your risk. To summarize, fundamentals explain why markets move, not just where price is. You want to focus on high impact indicators like the interest rates, like the CPI, or the employment change, and the gross domestic product. And last, you want to use fundamentals to anticipate volatility, to confirm trends, and to plan your trades smart. Even a small understanding on fundamentals will make you not only a smarter trader, but will also help you to avoid surprises and make better decisions. In the next video, we will apply all of this by diving deeper into trading psychology, so you can manage emotions and make clearer decisions.